Hello everyone, it's Thursday and you're watching Within the Frame. I'm Kim Bo-kyung. Key interest rates are frozen for the 8th straight session here in South Korea. The rate pause has been extended yet again as the Bank of Korea kept its policy rate unchanged at 3.5%. The BOK has a lot to consider before pivoting, the still existing inflationary pressure and rising household debt. However, considering the economic slump and rising woes over project financing developments, many are forecasting South Korea to start cutting rates within this year after the Fed does. What are experts' views on this? For this, we have invited Professor Yang Jun-sok from the Catholic University of Korea. Professor Yang, welcome.
Happy to be here.
And we also have Professor Shim Myungkyu from Yonsei University. Good to have you with us, Professor Shim.
Thank you for having me.
All right, first question to our Professor Yang. The very first rate-setting meeting for this year took place, and the BOK decided to keep its benchmark rate at 3.5%. We are going to talk about each factor one by one, but before we do that, could you briefly tell us the reasons behind such a decision?
Okay, well, the Bank of Korea right now is in a very difficult position. It cannot raise the rates or lower the rates without repercussions. And because one of the biggest factors that they have to consider is what will the U.S. Fed do. And right now, the U.S. Fed, it doesn't seem like it's going to change its rates in the near future. So basically, because they could not raise it or lower it, they punt it for the future. Now, some of the reasons that they should raise rates include what you said earlier, the inflation. There's rising household debt, but there's also rising corporate debt. And we want to try to bring the size of that down. But if you raise the interest rate to do that, then that means more burden on households and corporations. So that means probably less consumption and less investment. And then the interest rate reversal, the U.S. rate right now is at 5.5%, the policy rate. It's higher than Korea's, even though they're safer investment market. So right now, the problem is not serious, but whenever the interest rate reversal exists and it's large, then there's higher possibility that there will be a rapid capital outflow or even a currency crisis. So we don't want to worsen the rate reversal gap. But if we lower the rates, then we do increase that gap, and then there might be more problems with the inflation, with the increasing debt. But given the current GDP slowdown, there are also good reasons to lower the interest rate. So Bank of Korea is caught in the middle.
Right, BOK really must be in dilemma right now. Now, Professor Shim, let's tap on factors one by one. First of all is inflation. In December, consumer prices rose 3.2% from a year earlier, showing a slowdown for the second month in a row, though prices have stayed above the 3% level for 5 consecutive months. How did you see the figure?
Yeah, as you pointed out, the inflation rate seems to have become stabilized to be between 3% and 4%, particularly after November. So particularly after November, the inflation rate has become lower to at least 3%, which is quite low compared to the average inflation rate during the past 2 years. However, I think it is premature to conclude that the fight over the inflation rate is over for the following 2 reasons. First, the inflation rate is still higher than the target inflation rate of the BOK, which is 2%. Second, the inflation rate spiked up between August and October after being lowered to mid 2% during the middle of 2023. In this sense, we need to look at the core inflation rate, which measures the price level excluding food and energy prices. This still gives us a kind of a negative sign on the inflation rate. It has been stable at around 3% since last July, which is still higher than that was during the period before 2021, implying that there is still a threat on the inflation rate. Or maybe the the trend inflation rate has become higher, say to 3% or so, so that as some recent studies argue. So I think we still need some more time to conclude whether the inflation rate can become lower further to say mid 2% or just keep the same level.
All right, I see. So it would be premature for us to say the fight against inflation is over. Not yet. Now, Professor Yang, I'd like to stay on this inflation front. Seoul Metropolitan Government said that it is planning to increase the subway fare by 150 Korean won, which is just around 10 cents, as early as July this year. Is this plan in any way expected to, delay reaching the inflation target level?
Well, it will have an effect, but it'll be a very tiny effect, so it probably won't affect the major trends. Now, if you look at the main causes for inflation over the last 2 years, the first cause is production and supply shortages coming from the pandemic, the bottlenecks. And then the second is the Russian invasion into the Ukraine, which raised food and energy shortages and caused price increases. And then third, abnormal weather both inside Korea and globally, which increased food shortages during limited periods of time and raised prices on foodstuff. Now, factors 1 and 2, the pandemic-related factors and the invasion-related factors are definitely falling. So that is causing, it's still a high level of inflation, but the level of inflation is currently falling for most countries. So that is the major trend. But because Korea did not raise the subway prices or electricity prices in the past, we are now finally trying to catch up with the level that we should have. But if you look at the subway prices, how does it affect the consumer price index? Well, consumer price index is a weighted average of everything that a typical consumer consumes, and the percentage of the Metropolitan Railroad, including subways, which form that part of the calculation, is only 0.22 to 0.28%. It's less than even 1%. So 10-cent increase on that is not going to probably affect the consumer price index very much. As a comparison, electricity forms 1.6% of the CPI, and gasoline is about 2.4% of the CPI. So that explains why gasoline prices have a much larger impact. But because the subway prices form such a small part, and the large trends in the economy is for falling inflation rate, it's probably not going to have that much of an effect.
All right, good to hear. Now, Professor Shim, another reason why BOK maintained its restrictive policy is because of the bank's rising household loans, which rose for the 8th straight month in November. Could you tell us more about this first?
Yeah, what I and maybe also the other experts worry about is that if the interest rate becomes lower, it may trigger again the hike of the assets like housing or stocks, causing households to accumulate more debt to invest in such assets to get some capital gains. In this sense, I think the Bank of Korea should be careful not to give a wrong sign on the households that the interest rate will become lower very soon. Let me further discuss why household debt is really a problem in Korea. As was emphasized by a report published by the IMF last year, DSR level in Korea was the second highest among the countries that reported DSR in 2022, and thus further accumulation of household debt can be dangerous given that corporate debt is also the problem. The financial crisis between 2007 and 2009 gave us the lesson on the risk of accumulating household debt. Among all the recessions after the World War II, the financial crisis was the episode with the largest decline in operating activity together with slow employment recovery compared to the other recessions. And the risk that Korea faces at this point might be much higher than before because the household debt can trigger a severe recession if it is associated with lower housing price, as we might expect. Then financial constrained households will lower their consumption, as Professor Yang pointed out, resulting in a further decline in GDP. Since the interest rate is still high, the impact can be larger since more households will be borrowing constraints, so that the impact of say the bank run or the others will be much greater.
All right, I see, Professor Shim. Thank you for your explanation. Now, Professor Yang, since South Korea's monetary policies is very much affected by, the Fed's decision, I'd like to ask you this question. Even if the Fed decides to pivot, some say that it would be difficult for BOK to follow suit because of this size of the rate gap between Washington and Seoul. What's your view on this?
Okay, well, the problem is that right now the Korean interest rate is 3.5%. And the U.S. policy rate is 5.5%. So even if the U.S. decides to start to drop the interest rate, now they have given signals that their review of so-called neutral rate of interest, that is the interest rate that you have during normal times, has risen, and they're going to keep the long-term interest rate at 2.5%. Now, that means that either unless Korea wants to maintain the interest rate reversal for years, Korea will only be able to lower the rates by perhaps 0.5 to 1 percentage point if they want to have Korean rates being higher than the U.S. rates, or if Korea does decide to lower the rates with the United States percentage by percentage, then it will have to lower the interest rate and then raise it sometime in the future while U.S. maintains their rates. So Bank of Korea may be reluctant to lower the rates at the same pace as the U.S. Fed, but the chances are, because the Korean economy is undergoing such a big slowdown right now, if the U.S. does start to lower their rates, then Korea will probably follow as much as possible. But you also have to remember, we don't quite know when the U.S. will pivot. They said that they will pivot sometime this year.
Right.
They did not give any signals on exactly when. Other Fed members other than Chairman Powell have implied that they may not lower the interest rate at all. And the market is assuming that even though the Fed's dot chart has only shown 3 rate cuts this year, some of the market analysts are counting on 6 and starting at the first half of the year. So market may be over-expecting lower interest rate much faster than what the Fed has in mind.
All right, I see your point. Now, Professor Shim, now let's move on to the reasons why we need to consider cutting rates here. Our Professor Yang already told us, but it's first because of growth. The global economy is on course to record its worst half-decade of growth in 30 years, with the World Bank saying this year's is to dip to 2.4%. Now, South Korea is seeing slow recovery, but it cannot be sure about its exact rate of growth. Now, could you tell us more about this?
Yes, as you pointed out, forecasts on the growth rate in 2024 are somewhat gloomy. Not just the World Bank, but UN also recently cut down its forecast on the growth rate of the global economy from 2.5% reported last May to 2.4%. Several think tanks in Korea also predicted that 2024 will be a recessionary episode for the world economy. These pessimistic views are mainly due to the long-lasting high geographical risks, including the wars like Ukraine-Russian war and Israel-Hamas war, high interest rate, high inflation rate, and potential threats on the free trade, depending on the results from the U.S. election. And importantly, the expectations on China are also negative. The World Bank lowered its prediction on the growth rate of China from 5 to 2% estimate last year to 4.5%, which seems to be really a huge decline. All this downside risk can potentially throw down the growth rate of the Korean economy than expected, because our economy heavily depends on the international trade. In 2022, the dependence of GDP on export and import was greater than 100%, which is really high. And this figure implies that the worldwide recession will lower the demand for the goods that Korea can export, and thus it may have much larger impacts on the Korean economy than we have expected. So one might argue that the interest rate cut has to become more prompt than we have expected so that the Korean economy can prepare for the recession in advance. But given then the threats from the inflation rate and worries over the asset price bubbles, and also the interest rate gap between Korea and the US has become wide to like 2%, I think it is still premature to say that the BOK needs to cut the interest rate at this point. I think it needs to win more until it pivots because it is widely known in the profession that the cost of high inflation rate is much larger than the cost of having lower growth rate.
All right, I see your point. We need to wait. Now, Professor Yang, we cannot leave out concerns over this cash-strapped Taeyong ENC. Creditors of this Taeyong ENC is soon to decide whether to allow this builder to go forward with a debt restructuring program. For those who might not be familiar with this event, could you briefly tell us what this is?
Okay, well, the project financing market is the market that construction companies use to try to finance their construction projects at the beginning. Before they actually start construction, buying land and so on, and at the beginning stages of construction. Now, this market has been shaky for more than a year now, but if you want to look at the cause, you really have to go back to perhaps about 2008, right after the global financial crisis, when not only Korea but other advanced markets lowered their interest rates to perhaps historically low levels. What they did by that is increased the desirability of housing units. They did that by reducing the cost of the interest that they have to pay for loans. So a lot of people borrowed money to buy housing, and that increased the housing market. Some people say that that caused housing bubble prices as well. But this worsened during the pandemic because interest rate fell even further. A lot of companies perhaps overextended themselves by starting new construction projects and borrowing money from the project financing markets. And when the interest rate just started to go back up and very quickly, a lot of these companies found because of the high inflation, the cost of building was going up, while the cost of borrowing money was going up as well. So they were squeezed and they found formerly profitable projects becoming unprofitable, and then they had a problem with whether the government, regional government, will guarantee construction for construction bonds for Legoland last year, and that sort of frightened the whole market, raised the market interest rate even further. So Taeyong ENC was one of the companies which were caught in that squeeze, but it was always expected to be one of the weakest players because they had such a high debt to capital ratio. So they had a debt to capital ratio of, I believe, 478%. It was also one of the larger construction companies, the 35th largest construction company. So the concern is that, is this the first domino that can lead to not only decline of this company, but decline of other vulnerable companies as well. But luckily, during before the weekend, there were some doubts on whether the workout process can be successful, because Korean workout process insists that the owner families put in their own capital, put in their own wealth to rescue the company. This is contrary to what we normally think of as stock companies, limited liability companies that usually form most of these corporations. This reflects, I think, some of the cultural, economic peculiarities of Korea's chaebol system. But over the weekend, the owner families did say that they will put in a lot more of their wealth, including some of the SBS broadcasting shares that they own as a collateral. So right now, the workout seems to be a bit more optimistic. If the workout can be worked out, then we may prevent the domino effect from taking place, and we may squeak by this particular crisis. But a lot of it does depend on that vote that takes place on whether they will accept this workout, and it also depends on whether other companies will start falling down as well.
All right, I see your point. Now, Professor Shim, we are running out of time, but I'd like to ask you briefly about Fed's future decisions. Some 216,000 jobs were added in the U.S. last month, defying fears of a downturn even after the Fed launched its aggressive campaign. Now, how does such resilience affect the Fed's decision to pivot? And the December's U.S. Consumer Price Index will be released soon, right? How do you expect the figure to be?
I think such a positive sign on the labor market, which we have observed for the last 1 or 2 years, give more time for the Fed to wait until the inflation rate becomes lower to about 2%, which is its target rate. First of all, this is a sign that the U.S. economy can still endure the potential hike in the rate or can keep the current level for a longer period than the market expects. And if we look at the consumption expenditure, it also shows us a kind of the positive sign. The growth rate from a year ago was about 3% in the third quarter of 2023, which is the second highest level since 2022. As a result, the aggregate activity in the U.S. seems to give more room for the Fed not to pivot soon. And given that the most recent inflation rate was 3.1%, which is still higher than the target of the Fed, I guess. And also, I expect that the inflation rate will not vary that much from 3.1%, given that the core inflation rate of the U.S. has not changed that much. And the Fed will still wait until it receives more signs on the inflation rate that it will decline very soon. So I think it will keep the same policy, wait-and-see policy, until it receives more signals to make a pivot.
All right, I see your point. Now, unfortunately, this is all the time we have for today's edition. Thank you, Professor Shim and Professor Yang, for your time and insights. We really appreciate it.
Thank you.
Thank you.
All right, that's all for Within the Frame tonight. We'll be back tomorrow with more in-depth stories. Thank you for watching, and goodbye.